I don't know if this happens to you, but I opened my electricity bill this month and literally had to sit down.
Oh, man. Yeah, it's rough right now.
Like, I was staring at the total, trying to figure out if I had, accidentally started a commercial laundromat in my basement, or if my neighbors were secretly tapping into my grid.
Just mining Bitcoin in the crawl space, right?
Honestly, it crossed my mind. The sheer cost was just staggering. And as I was sitting there at my kitchen table, just looking at this piece of paper, it sent me down a bit of a rabbit hole.
Oh, here we go.
Yeah, no, seriously. It got me thinking about the invisible, like physical costs of keeping our digital lives running. We send a text, we stream a video, we buy a digital asset, and it all feels so weightless.
Right, like it's just magic.
Exactly. But behind every single byte of data, there is a massive data center somewhere, a roaring cooling system, and just raw physical energy being burned.
It really is the great illusion of the modern age. I mean, we treat the internet and by extension, digital networks like they exist in this ethereal, floating cloud.
The cloud.
Right.
Yeah, the cloud. But that cloud is deeply, fundamentally anchored in concrete, steel, copper wire, and a truly staggering amount of baseload electricity.
Yeah.
The digital world is incredibly heavy.
Yeah, it has a massive physical footprint. And that heavy physical reality and, who actually pays for it is exactly what we are getting into today. Welcome to Inside Bitcoin.
I am really looking forward to unpacking this one today.
So today's deep dive is going to explore what actually gives digital property its staying power. Yeah. We want to bypass the usual market noise for you, the day-to-day hype cycles on social media that just distract from the real mechanics.
There's plenty of that right now.
There is. Instead, we are looking straight into the engine room of the Bitcoin network. We're asking the hard questions about Blockspace, network security, and, well, what happens when the underlying economics of this massive energy-consuming system start to shift right under our feet?
Which is incredibly timely considering the rather turbulent macroeconomic environment we find ourselves in right now. Exactly. Let's set the macro stage so you have the full picture of what we're looking at this week. It's June 5th, 2026. And the last few days have been incredibly tense across the board.
Tense is a good word for it.
Yeah, tech stocks just took a brutal 15% hit. The market is basically holding its breath ahead of a highly anticipated U.S. jobs report, and that anxiety is spilling over everywhere.
The broader crypto market is bleeding right alongside traditional equities.
Yeah, Bitcoin is currently testing a floor right around $61,991. The one piece of good news is that the heavy outflow bleeding from the ETFs seems to have plateaued, but the pressure on the system is palpable.
And that macroeconomic context is crucial because it shatters a very comfortable illusion that a lot of participants have held on to for years.
What illusion is that?
Well, for a long time, the underlying assumption was that Bitcoin's price appreciation alone, this sort of endless upward trajectory against fiat currencies, would indefinitely cover the costs of network security.
And number go up forever.
Right. But when you have tech stocks dropping 15% in a single week because the global market is terrified about inflation or employment data, it proves that you cannot rely on endless price pumps to pay for real-world energy.
Which brings us to the core of today's deep dive. This research comes from Mo and Moestradamos research team. And their fundamental point is that as the block subsidy shrinks, the people securing the network are feeling a massive squeeze.
Yeah, the miners.
Right. Let's make sure we are all on the same page regarding that mechanism. The block subsidy is the built-in reward, the newly minted Bitcoin, that miners receive for successfully verifying a block of transactions.
But that subsidy gets cut in half algorithmically every 4 years.
Exactly. So if the network can't rely on the price of Bitcoin doubling every cycle to offset that shrinking reward, we have to ask a very serious question. What is actually going to generate the recurring fee demand to keep those machines running?
To really understand the gravity of that question, you have to look at the miner's business model. A miner isn't just running a laptop in their bedroom anymore.
Right, those days are long gone.
Oh, completely. They are running industrial-scale facilities. They have massive capital expenditures. I mean, buying the ASIC machines, building the cooling infrastructure, negotiating land leases.
And the electric bill.
They have massive operating expenditures, primarily their monthly utility bills. Their profit margin is just the value of the Bitcoin they mine minus the cost of the electricity they consume.
I try to visualize the network Like a massive fleet of armored trucks driving across the country, securing and transporting incredibly valuable cargo.
That's a good way to look at it.
Thanks. But the security of those trucks doesn't come for free. The armor plating, the armed guards, the diesel fuel, that's all physical energy and capital being expended.
Right.
In the early days of Bitcoin, the network essentially subsidized that operational cost by magically printing new cargo, the block reward, and just handing it to the drivers.
Yep.
But as we know, that built-in subsidy is mathematically designed to trend towards zero.
And that brings us to the crux of the issue. If the newly printed cargo is getting lighter and lighter, who is paying for the diesel fuel to keep the armored trucks on the road?
Someone has to pay.
Exactly. The answer, structurally, has to be the people putting things inside the truck, the users. The users making transactions have to start paying higher fees for the transport. The transaction fees have to replace the block subsidy.
Which means we are on a hunt for a second subsidy. If the base reward is shrinking, what kind of economic activity could theoretically replace it?
We need something that supplements minor revenue enough to keep those armored trucks running securely.
And this is where the conversation moves into some profoundly interesting territory. Bitcoin native objects. Specifically, we're looking at NATs, which stands for non-arbitrary tokens, and a broader framework known as digital matter theory, or DMT.
Let's break down why that distinction is so important. The vast majority of digital tokens you encounter in the broader ecosystem are completely arbitrary.
Like completely made up.
Right, completely made up. A developer team decides out of thin air that they want to create 1 billion tokens. They write a smart contract on an alternative blockchain, press deploy, and suddenly those tokens exist.
Poof.
Poof. The supply, the issuance schedule, the traits of the token, they are all human decisions. They are arbitrary. They have no structural or mathematical relationship to the underlying blockchain itself.
It's like a casino printing chips. The chips only have value because the casino says they do. And the casino can always just, decide to print more chips or change the rules of the game.
Precisely. Digital matter theory and the NATs born from it take a radically different approach. Instead of a developer making up rules, the rules are extracted from the actual ordered proof-of-work history of the Bitcoin blockchain.
Extracted, not invented.
Yes. Think of the blockchain not just as a ledger of transactions, but as a massive geological formation. Over the past 15 years, blocks have been laid down one by one, like strata in a canyon.
Okay, I like that visual. Each block contains unique deterministic data. Things like the specific hash of the block, the difficulty target at that exact moment in time, the nonce value that the winning miner discovered.
Real hard data.
Exactly. DMT suggests that we can use that existing historical data as the DNA to create digital property. The tokens are born from the very environment of the network itself.
Okay, that is fascinating. So instead of a developer saying, I want to issue 1 million tokens today, a NAT protocol might say, we will issue tokens based on the specific numerical value of the hash in block 750,000.
Exactly.
It's extracting digital matter from the digital earth rather than just printing it in a factory. And the market is clearly starting to pay attention to this framework.
It definitely is.
Just this week, we saw NATs experience a significant surge, reaching toward a $150 million market cap. Even more notably, they've secured listings on major external centralized exchanges like MEXC, LBank, and CoinEx. It feels like a massive moment of validation for this ecosystem. It is a significant milestone in terms of cultural visibility and speculative interest. Getting listed on major centralized exchanges provides access to a much wider pool of global capital.
Yeah, that liquidity is huge.
However, and we must be rigorously analytical about this, we have to be very careful with our proof burden here. A theoretical market cap of $150 million on centralized exchanges does not automatically translate into actual Blockspace fees.
Wait, let me stop you there because that feels counterintuitive.
Okay.
You're saying that even if a specific piece of digital property is trading at a high valuation, even if people are buying and selling millions of dollars worth of it every day, the security guard, the miner securing the network, might not be seeing a single dime of that activity.
That is exactly what I am saying. We have to trace the actual mechanics of the trade. If a trader in Tokyo buys a NAT from a trader in London on an exchange like MEXC, how does that transaction happen?
On MEXC servers, right?
Yes. It happens on MEXC's internal databases. Their proprietary matching engine simply updates an internal ledger. Trader A's balance goes down, Trader B's balance goes up.
So it never touches the chain.
Never.
Yeah.
That transaction never touches the Bitcoin blockchain. It requires zero block space. Therefore, the industrial miner sitting in Texas, burning gigawatts of power to secure the Bitcoin network, sees absolutely nothing from that trade. Zero fee revenue.
Wow. So the high market capitalization creates a lot of cultural energy, and it certainly creates speculative wealth for the traders involved. But unless that trading activity drives repeated, sustained on-chain transfer where people are actually moving the asset across the base layer and bidding for block space, it does absolutely nothing to secure the network.
It is the difference between trading paper derivatives of a commodity and physically moving the commodity itself. If you trade a paper gold contract on a screen, you aren't paying a logistics company to load physical gold bars onto an armored truck.
Right.
The miner only gets paid when the physical gold, or in this case, the on-chain digital matter, is actually moved.
That distinction fundamentally changes how we have to evaluate the success of these projects. We can't just look at the ticker price, right? We have to look at the on-chain velocity.
Absolutely.
And that realization bridges us to an even more pressing operational hurdle,
Yeah.
the miner's liquidity bottleneck.
Yeah.
Because, returning to our armored truck analogy, even if users are moving the cargo on-chain and paying high fees in the form of these newly valuable nats, how does the miner actually capture and utilize that value?
This is where the physical reality of running a data center collides violently with the theoretical value of digital assets. Let's look at the competitive landscape for a miner in 2026.
Okay, set the scene.
They are not just competing against other Bitcoin miners for block rewards anymore. They are competing head-to-head with artificial intelligence companies and high-performance computing data centers for the exact same resources.
Oh, right. Access to high-capacity energy grids, industrial real estate, specialized cooling infrastructure.
Exactly. Because an AI model training facility needs massive amounts of electricity, and they are well-funded and aggressive. They want the exact same cheap, reliable power that the Bitcoin miners rely on to maintain their margins.
And here is the unyielding reality of the physical supply chain. Mo's research highlights a really severe liquidity trap here. Utility companies, grid operators, hardware manufacturers, they do not accept theoretical tokens.
No, they don't.
They don't accept nats or network goodwill as payment. They want cold, hard fiat currency. They need dollars or euros to pay their own physical supply chains. So a mining operation needs absolutely reliable, liquid revenue and deeply predictable cash flows.
This is a dynamic that I think the broader market completely misses when they cheer for high token valuations. Let's game this out.
Okay, let's hear it.
Suppose a miner is successfully processing blocks that contain a high volume of transactions involving valuable Bitcoin native assets. Maybe the miner is even accumulating some of these nats directly as secondary rewards or specialized fee premiums.
So they're getting paid in nats.
Right. On paper, their corporate balance sheet looks fantastic, but how do they actually pay the electric bill at the end of the month?
It fundamentally boils down to an order book problem, doesn't it?
Exactly. Let's say our hypothetical miner has accumulated $500,000 worth of a highly sought-after nat. When their utility provider demands payment, the miner has to liquidate that asset. They have to sell it for fiat.
Right.
But if they go to an exchange and dump a $500,000 market sell order into a relatively illiquid nascent market, what happens?
They crash the price of the asset immediately.
Exactly. They chew through all the buy orders on the order book. The first $10,000 might sell at the market price, but the next $10,000 sells for 5% less, and the next block sells for 10% less.
Slippage.
This is a severe slippage. By the time they have unloaded the entire $500,000 position, they might have driven the price of the asset down by 40 or 50%. So they don't actually extract $500,000 in usable cash. They extract a fraction of that paper value.
Which means they can't pay their full utility bill. It's one thing to be rich on paper. It is an entirely different operational reality to have the deep liquid cash flow required to keep industrial machines humming 24/7.
Therefore, until these Bitcoin native assets develop incredibly deep liquidity pools, robust fiat off-ramps, and institutional-grade OTC, or over-the-counter trading desks that can absorb massive blocks of selling without moving the spot price, they simply cannot serve as the foundational bedrock for an industrial miner's operating budget.
The market structure just isn't mature enough to support the physical weight of the network's energy demands.
Not yet, no.
So if the financial realization of these assets is so fragile for the miners trying to secure them, we naturally have to look at the assets themselves. Are they structurally robust?
That's the next logical question.
Right. If the money is hard to extract, is the underlying property at least permanent and reliable for the end user? Let's introduce the concept of native digital matter using Bitmap as our lens. And just to give you the exact terminology. Bitmap as in bitmap, Bitcoin block mapping?
Bitmap is arguably one of the most elegant and literal applications of digital matter theory that we have seen so far. It provides a mechanism for an individual to essentially claim ownership over the spatial representation of a specific historical Bitcoin block.
How does that actually work in practice?
When you inscribe a bitmap, you are etching a cryptographic claim into a specific Satoshi, the smallest unit of a Bitcoin, stating that you are the recognized owner of that block's data architecture. It is perfectly sovereign.
Because it's on-chain.
Exactly. The record of your ownership is indelibly recorded onto the base layer of the Bitcoin blockchain. As long as the network exists, no one can alter that fundamental cryptographic truth. You own the deed.
And that sounds perfect. That sounds like the ultimate trustless digital property. But as I dug into how this actually functions for a normal user, I hit a wall that I frankly found a little concerning.
The infrastructure layer.
Yeah. Despite having that perfect, sovereign, unchangeable origin record on the blockchain, the broader ecosystem relies heavily, almost entirely, really, on centralized parsers, independent indexers, and recursive renderers to actually make sense of the data.
That is the critical vulnerability, and it is a fascinating paradox of this entire movement. The blockchain itself is just a globally synchronized ledger of hex data. It is raw alphanumeric code.
It's not pretty.
No, it's not. The blockchain does not have a screen. It doesn't have a user interface. To visually see your bitmap, to interact with its map, to view its specific traits, to list it on a marketplace so someone else can evaluate it, you need software to translate that raw data.
So you need a whole stack of third-party tech.
You need a parser to read the hex code, an indexer to catalog it against all the other inscriptions, and a renderer to generate the visual output on your web browser.
I want to make sure I fully grasp this because the implications are huge. You're saying that if I buy a highly valuable NAT or a bitmap, my ownership is secured by the most powerful decentralized computer network in human history. But my ability to actually look at it or prove to a buyer what it looks like might depend on a small team of developers running a server on AWS.
That is the unfortunate reality right now.
What happens if that specific independent indexer decides they run out of funding and shut down their servers?
It breaks. The experience of the property completely breaks. Now, to be incredibly precise, the underlying property is still perfectly intact on the blockchain. Your cryptographic ownership hasn't changed. The mathematics are sound. The raw data is still sitting exactly where it was.
But I can't see it.
Right. Your ability to perceive it, interface with it, or trade it on a visual marketplace ceases to exist.
It's like owning a beautifully preserved, theoretically perfect DVD movie, but someone else owns the only DVD player in your city.
That is a brilliant analogy.
Well, thank you. But seriously, the movie on your disc hasn't degraded or changed. It's safe. But if they lock the doors to their shop, you are just sitting in your living room, staring at a piece of circular plastic. You can't watch the movie.
Exactly. It reveals that while the base asset might be fully decentralized and sovereign, the infrastructure layer we rely upon to perceive and utilize that asset is currently highly centralized and deeply vulnerable. This is the trust boundary.
The trust boundary.
Yes. You have moved from a trustless environment, the math of the blockchain, into a trusted environment, hoping the indexer developer keeps their API updated and their servers online.
And if we are worried about trusting a third-party developer just to render an image on a screen, that vulnerability compounds exponentially when projects attempt to pull these digital assets out of the internet entirely and into the physical world.
Oh, absolutely. This is where things get really messy.
Let's look at the distinction between purely digital origin records and physical bridging risks. Because I know projects like NatCats are exploring all kinds of utility.
This is a massive trap, and it is one I see both builders and investors falling into repeatedly right now. They conflate the absolute native digital provenance of the blockchain with real-world physical claims. We have to separate the two entirely.
Right, let's establish the baseline with the digital side first. The beginner bridge for anyone moving from just holding standard units of Bitcoin to holding non-arbitrary digital property is understanding public origin records.
Right, tracing the history.
You look at the history of a rare Satoshi, you trace its specific block history, you use parser reconstruction to verify its traits. For purely digital items like a piece of on-chain art or a NAT, this provides a framework of perfect trust. It is completely deterministic. You can run the math yourself and verify it.
Yes. In the purely digital realm, because it is entirely enclosed within the system, trust is absolute. It is guaranteed by cryptographic math and the physical energy expended by the miners. If the ledger says you own it, you own it. There is no ambiguity.
Right.
But the moment a project attempts to connect those pure digital objects to physical redemptions, everything falls apart.
Okay, give me an example.
Say a project issues a NAT, and the promise is that holding this NAT entitles you to claim a limited edition pair of physical shoes or exclusive merchandise shipped to your house.
Which, sounds cool in theory. It sounds like a great utility for the token.
It sounds cool, but conceptually, they have immediately reintroduced ordinary, messy, legacy, third-party fulfillment trust. You are stepping completely outside the boundaries of cryptographic consensus.
Because the blockchain can't mail you shoes.
Exactly. The blockchain cannot enforce a physical supply chain. It cannot force a warehouse worker in Ohio to actually put your shoes in a cardboard box. It cannot guarantee that the delivery driver won't lose the package, or that the manufacturer didn't use cheap materials that fall apart in a week.
So you can have the most mathematically pure, proof-of-work-backed, immutably secure token in the universe sitting safely in your cold storage wallet.
Yes.
But if the guy running the logistics company goes bankrupt or just forgets to check the shipping ledger, your token is useless for that physical claim.
It's a fundamental misunderstanding of what the technology actually achieves. The blockchain solves digital scarcity and digital provenance. It eliminates the double spend problem for data.
But not for sneakers.
But not for sneakers. The moment you introduce a physical, real-world counterpart, you are relying on traditional legal contracts, human honesty, and logistical systems. This completely defeats the entire purpose of creating trustless digital matter in the first place. You've built a multi-billion-dollar cryptographic fortress just to hand the keys to a guy driving a delivery van.
So let's synthesize all of this, because it feels like we are painting ourselves into a corner here.
It does a bit, doesn't it?
We've established that physical redemptions are fundamentally flawed by human trust. We've established that human traders often just swap theoretical tokens off-chain on centralized exchanges without paying the miners a dime in fees.
Right.
And we've established that even pure digital assets rely on fragile, centralized renderers to be visually useful to humans. So what is the true trustless use case?
That is the million-dollar question.
What activity is actually going to drive the durable, recurring on-chain fee demand required to keep our armored trucks running and secure the network long-term?
To find that answer, we have to look past human behavior entirely. We have to move beyond speculative retail token trading, and we definitely have to avoid the pitfalls of physical merchandise.
Okay, so if not humans, then who? Or what?
The focus of the most advanced research right now is decisively shifting toward the machine economy. We're talking about artificial intelligence agents and autonomous machine-to-machine payments.
Wow. Okay, this feels like the actual paradigm shift.
It really is.
Because when you think about it, an AI system doesn't care if a visual rendering on a marketplace breaks because a front-end server crashed.
Not at all.
The AI doesn't have human eyes, it doesn't need a pretty interface, it natively reads the raw hex data. And an AI certainly doesn't care about redeeming a token for a physical pair of shoes.
Obviously not.
What an autonomous agent cares about is verifiable, cryptographically secure truth. They care about what we call sovereign receipts.
This is where the raw mechanics of Bitcoin truly shine, and where the limitations of human perception no longer matter. Imagine a near-future economy, which, by the way, is rapidly becoming a present reality, composed of millions of autonomous AI agents.
Millions of them.
Yes. These agents are negotiating bandwidth, contracting computational power, renting server space, and executing digital tasks with one another at lightning speed. An AI agent doesn't have a corporate bank account.
Right.
It can't sign up for a Stripe account or a credit card. If Agent A needs Agent B to perform a complex data scrape, how do they settle that transaction trustlessly?
They need an immutable, unforgeable ledger. They need a system where Agent A can prove definitively and mathematically that it paid for the service, and Agent B can log a permanent proof-of-work receipt demonstrating that the task was completed.
Precisely. By utilizing the Bitcoin base layer to record these sovereign receipts, logging proof of access, service completion, or securing a reservation for future computation autonomous systems could create exactly the kind of repeated high-value settlement demand necessary to sustain the network's security budget.
Because they have to be sure.
Yes, and AI is willing to pay a premium fee for block space because the immutability of that block space is the only way it can securely operate in a trustless digital environment.
I love this because it completely reframes the ongoing, sometimes really toxic debates we see in the broader community.
Oh, the spam debates.
Yes, people are constantly arguing about whether arbitrary data inscribed on the blockchain is just network spam clogging up the pipes for pure financial transactions.
It renders that debate entirely obsolete. Data isn't network spam if that data acts as a valuable cryptographic receipt anchoring a massive autonomous machine economy.
It's just commerce.
Exactly. If an AI agent is willing to outbid a human sending a standard financial transaction in order to embed a proof of service receipt into a block, that is not spam. That is free market commerce operating exactly as designed.
The highest bidder wins the block space.
Yes, it is providing the exact aggressive fee pressure the miners desperately need as the algorithmic block subsidy continues to shrink.
It's a complete shift in perspective.
Yeah.
It's not about cultural enthusiasm or meme coin hype or hoping the price of a token goes up so you can sell it to someone else.
No, it's much bigger than that.
It's about creating an industrial substrate where an AI agent pays a hard fee to permanently prove it completed a task. We're watching the transition from a human speculative casino into an autonomous industrial bedrock.
And that transition is the only mathematically sound path to long-term network sustainability. Which brings us to the ultimate question for you to mull over as you navigate this space.
Leave them with something to think about.
As the block subsidy continues to drop over the next few months and the economic reality of mining grows increasingly tight, what specific metric will you be watching to determine if Bitcoin native objects are actually succeeding in securing the network?
That's the real test.
Will you be distracted by the theoretical market caps on centralized exchanges, or will you be tracking the actual percentage of miner revenue derived from autonomous machine economy settlement fees? Because one is temporary noise, and the other is the future of digital security.
If you want to continue the conversation and stay updated on Bitcoin price action and developments across the Bitcoin DMT ecosystem, check out the Discord link in the description or on the channel, where Mo will be sharing ongoing Bitcoin native digital matter research, DMT-NAT insights, and project updates. We'll see you next time on Inside Bitcoin.